In this week's update, my 2026 investing strategy. Macro re-rating for precious metals, copper, aluminium, lithium, rare earths, plus other critical metals. And the final call for our biggest discount ever. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. All right, how are things looking for the balance of the year? And I've got to say, they're looking pretty positive at the moment. So from a big picture point of view, 2026 has started strongly, and not only just because prices are going up, but the fundamentals are looking pretty good in most places as well. So we've now seen numerous sectors and subsectors are now joining the momentum. There's been momentum in parts of the market throughout 2025, but now we've got more stocks joining in with that and breaking out to new all-time highs. The valuation reset away from high PE multiple stocks, particularly technology stocks, continues, but as I indicated before the Christmas break, it was looking more likely, rather than any sort of significant pullback, that the valuation reset would just get taken care of over time. There would be a mildish rotation from these high multiple stocks into other areas of the market. And also time would play a factor as well, because if these stocks continue to grow their earnings at a strong rate, then the PE ratio becomes lower and lower very quickly. So it's a combination of those two factors that now seems to be playing out. If we look at the fundamentals, US earnings expectations remain intact. We're seeing the absolute overwhelming majority of analysts are moving earnings expectations up and revenue expectations up. And we've got the reporting season starting in a few weeks. We've also got the likelihood of more interest rate cuts in America. So we've got easing financial conditions. So the fundamental backdrop is just really, really positive for this stock market rally to continue. Now, having said that, it's unrealistic to expect for it to continue in a smooth, nice uptrend. I can say with a fair amount of conviction that is not going to happen. We're going to see uptrends and probably strong uptrends, but they're going to be volatile. We'll see some sharp pullbacks and some sharp advances. And they're the sort of market behaviours that really catch the unwary out. So you're going to need to be on top of your game to play those volatile cycles. But the good news is that the trends remain strongly to the upside in many parts of the market, not just a few, but many parts of the market. So any risks that are out there, and of course there always are, and there's a huge number of geopolitical risks, probably more than we've normally seen, but the risks are really driven by events. They're not systemic risks. They're not risks that earnings are starting to deteriorate and leaving PE multiples way too high, something that's going to take much, much longer to adjust to. I think the risks are going to be much more short-term. So it's really a matter of negotiating that volatility. So my strategy for 2026, I think I've been pretty clear over the years in running this video about what the principles are that I use. And this isn't a change in that methodology. It's just a bit of a shift in how I emphasize or how I weight the various decision points between looking at the fundamentals and looking at the technical charts. So I'm just shifting the balance a bit more to acknowledge momentum, to respect momentum a little bit more than the long-term fundamentals. So that means two things. It means that I'm going to be a little less tolerant of the great story that isn't moving yet, but promises to do so. Just going to be a little less tolerant of the time involved there, because there's so many opportunities that have got fantastic momentum. I don't want the money pool to get lazy, if you like. And if I'm assigning a little less weight to the long-term fundamentals, or a little less importance to the long-term fundamentals, then obviously that will translate to more weight into stocks that are trending now, not where the fundamentals would suggest they're going to trend at some point in the future. So I'm respecting the money flows a bit more emphasis on the technicals. And I would really implore watchers of this video and remind members of the Insiders Club not to allow logic to dominate your decisions. I get it. It's really easy to look at logical fundamentals that add up to what appears to be an absolute no-brainer and conclude that that is how the price action must work. I made that mistake back in 2019 when uranium really looked like an absolute no-brainer. But it took another 3 or 4 years before the market agreed with me. So the logic around uranium back in 2019 was just way too early, and too much time could have been wasted on that part of the market. So logic does not always play out or does not always translate to the price movements that you would expect. We're also increasing the weightings to early stage stocks. Now in the Insiders Club, we've got an early stage portfolio, which are stocks that are pre-profit and therefore offer much more significant leverage to the upside. However, because they're more risky, because they're pre-profit, and because they're more volatile, we've always reflected that in very small weightings. So that's how we've managed risk, through very small weightings. But because of some other changes that I'm making in methodology, tweaks if you like, then we are increasing our initial weightings to early stage stocks as well. So that gives us the exposure to that leverage. And to be honest, this is the best environment that I've seen in my investing lifetime for 5 and 10 baggers and above. And we're seeing many of them at the moment. There really is some incredible momentum, particularly, not only, but particularly in the resources sector. It's backed up by extraordinarily good fundamentals and positive fundamentals and high probability fundamentals, but it's also backed up by just really robust uptrends as well. And it covers resources in many forms. It covers digital healthcare. It covers technology. It covers industrial technology. There are numerous areas of the Australian and US market that are beneficiaries of this. So the bottom line is, if you follow the 7 megatrends that have really got logically unstoppable tailwinds, then you're making sure that you're in sectors that have got continued momentum. So these are the fundamentals that make sure that we're fishing in the right place. And then we turn it over to the charts and the money flows to guide our entries and our exits. Now, some things never change. These are the core principles that I talk about in the Insiders Club all the time. You've got to have a clear and simple plan to remove emotion and to be able to execute consistently well. And I talk about that almost every week in this video, so that statement should not come as any surprise. You've got to be honest with yourself about your tolerance to volatility. And if you're not very tolerant to volatility, that's absolutely fine. Just acknowledge it and structure your plan accordingly. You got to know your purpose for every stock you own, and you can have different purposes for different stocks. In fact, it would be almost improbable that you could have the same purpose across every stock in your portfolio. It's just incredibly unlikely. So just be clear about it. Make a note of it somewhere, on a spreadsheet, on a chart, on a yellow sticky note paper, whatever works for you. But understand your purpose for every stock you own, because if you don't understand the purpose, why are you in there? What are you expecting to happen? What is your anticipated time frame? If you don't understand that, how can you make decisions about entries and exits? It's impossible to guess. So, that is really, really critical. And you've also got to know what your exits look like. We can never know where the exits will be, and that's why we've got to be guided by the price action. But it's very easy to understand what your exits look like. What has the price chart got to do to influence you to sell or reduce your exposure? And you can determine that in advance. You don't have to wait. Another really important thing is to shut out the noise. It's very easy to get caught. In fact, human emotion, our wiring is that we have a negative bias, that we're more fearful of negative outcomes than we are greedy about profitable outcomes. So just be aware of the negative bias creeping in that causes a lot of investors to basically be like a rabbit in the headlights or a deer in the headlights. fear sells, that's the reality. That's why the bulk of media reporting will be emphasising negative events. It's about them getting clicks and eyeballs. And their goals are absolutely not aligned with yours. So the question I would pose is, so why would you listen to them? Why would you take notice of what's in the media when you understand what their game plan is? Their game plan has got absolutely nothing whatsoever to do with making you a successful investor. Don't fear corrections or crashes that follow bigger corrections. They're almost always easy to spot. I've been running this video now for 16, 17, 18 years. I've lost track of how long, almost every week. And my track record is publicly available through this YouTube channel. It's not important to me to pick when the turning points are. I'm just passing on what I observe about the market. And if it turns out to be correct, that's great. And hopefully I've helped a lot of people over the years. The opportunities created by these corrections and occasionally crashes, they're where the well-informed and the well-prepared, particularly the second one, the well-prepared, really make their money. Over the journey, you will make a significantly larger amount of money from a very small number of stocks that you get right and you stay with. So it's important to seize the opportunity when it presents. Now, as you're aware, over recent weeks, we've been running a discounted offer that closes on Tuesday coming, so in 48 hours' time by the time you're watching this video. And just to recap quickly, it's $399 for the next 3 months, which is a 47% discount to the normal subscription membership. Or if you don't want to do it as one bulk sum for 3 months, you can do it in 3 installment payments of $179. So that's been available for a couple of weeks, and there is the link below, but it is going to be closing, and we will close it early if we get a rush of memberships in the next couple of days, because we place more emphasis on serving existing members than allowing the membership to get unwieldy. And look, to be honest, I'm not that far off my practical limit because I'm not prepared to compromise on the service level that is provided to existing members. So there is a practical limit to how many numbers we can have in the membership. And if you want to hear from what our members are saying, there's a great depth of testimonials on our website. You're very welcome to go and have a look at those. And the overwhelming theme that comes through from those testimonials is that we're empowering members to be far better at what they do and getting far better results. So there's any amount of evidence. And the results that we've been getting, again, these have been put up from time to time. We've been running these core and early stage portfolios for just a touch under 3 years, just a couple of weeks short of 3 years. And the record that we've got, the profit factor, anything that you see that is a number above 2 is considered to be a good to excellent return. So these are results that we're very pleased with, that members are very pleased with. And members can see a full record of transactions on our website from day one. This is not just, one overall banner. Every single transaction is on the website. And that's, of course, been through the compliance process with our licensee. So the key to success is not about being right every time, because that's completely unattainable. It's about letting your winners run and limiting your losses. And you can see there that our win rate is 57.5%, but where the big advantage is that the size of the winners is significantly larger than the losers. And that's what you want if you're active in the market. And turning now to the early stage portfolio, and of course, with all of these, the past performance, what we've done over the last 3 years is a good indicator, but it is by no means a guarantee of how things are going to perform in the future. But because we have a process, a repeatable process that is primarily about managing risk, then I'm confident that we're going to be able to continue in a similar kind of vein in the future. So this is the performance of the early stage portfolio, and you can see that the profit factor here is 4.26, which is really very, very strong. And it's taken off in recent months as well, because many of the stocks that we've got into in the last 6 or 12 months are really delivering on the high potential that they already had. We've just come into a different phase of the market where that potential is getting recognised. There's more information on our website, and I'm happy to speak with anyone that's interested in understanding more about the processes we use, how the communication works, all of that sort of thing. So there you go. Now, of course, as always, we recommend that before you do anything, acting on anything in this video, that you get all the advice that you need in all respects. Right, turning now to the market. The S&P was up 1.6% for the week, the Nasdaq up almost 2%, but it was the Russell, it was the small caps that really did well. Absolutely burst out to new all-time highs, up 4.6% for the week. It's really impressive, the breadth, and that's what is likely to sustain this market when you've got such impressive breadth and such robust performance by so many stocks. There are literally hundreds and hundreds of really powerful uptrends that I've got just in my watch list. And I'm by no means covering the whole market. And I'm getting to the point now where working through a robust uptrends workbook actually starts to take a fair amount of time. So the US market, there is just opportunities left, right, and center. Now the US index, US dollar index, was rising, which is really surprising because the Australian dollar went up, commodity prices went up, but the US dollar index went up as well. So a bit of a strange week. The 10-year yield edged up a little bit. I think it was 4.14 before the Christmas break. It's now 4.18. So it's sitting stable in that sort of 4.1 to 4.2 area. The VIX also has remained sub 15, which is indicating there's not much fear in the market. All right, let's go in and look at some charts. So this is the Nasdaq Composite to start with. This is a daily chart. So you'll notice on Friday, we've now popped our head above this little downtrending trend line. So you can look at this in several ways. You can look at the triangle, which is here and here, and conclude that we're going to get resolution to the upside in a continuation pattern. So the pattern continues in the direction of the trend before this consolidation period. So we've got a very strong trend here that started back in April, where we formed higher highs and higher lows. Then we went into a consolidation. And you can look at this consolidation in two ways. You can either look at it that way as a triangle, or you can remove this trend line and look at it as an ascending triangle. But whichever way you look at it, the probabilities are, and that's all we've got. It's just probabilities. But I can only see two highly probable scenarios. Let me put it that way. There is a third scenario, and that is that the market breaks down and breaks below this trend line, this rising trend line. But I can't assign very much probability to that at this point in time. Everything points to resolution to the upside above this horizontal resistance line. So that's the Nasdaq looking very positive. This is the S&P on a weekly chart. So another new all-time high. And I can't remember the numbers, but there's always numbers around about how if January starts well for the US market, then 85 or 90% of the time, I'm just guessing here, but the theme is correct. When January is positive, generally the whole year is positive for the American stock market. So the S&P certainly started the first week and a little bit in a very positive manner. The RSP, so this is the equal weight S&P index, also on a weekly chart is breaking out. So we're not lacking in market breadth. But this is where the real positive action is. This is a weekly chart of the Russell 2000, which covers small caps. And we've really burst out in the last couple of weeks to new all-time highs. We broke out. We spent 3 or 4 weeks just kind of meandering back in a bit of a half-hearted attempt to retest the breakout. And then last week was the start of some really good action. And look, to be honest, these 3 weeks you can probably discount because of the Christmas New Year break and the very thin liquidity. So no surprise that the market really didn't go anywhere much. But as soon as the market got back onto a more normal footing, then off it went. It was very, very strong. If we look at the currencies, there we are with the US dollar index. So a fairly concerted move to the upside last week, which is quite surprising that the Australian did not come down further in the inverse correlation. But I guess that's because of the strength in commodities, and the Australian currency is regarded as a commodity currency. It's going to do well when commodities do well. So that's probably the reason that it's holding up. Turning now to the Aussie market. This is the ASX 200 on a weekly chart. So you can see absolutely flat. I think it was only some single-digit number of points change over the week. The gains were in resources. This is XJR, the resources index, again on a weekly chart. A little bit of selling at the end, but I think we'll find that that is very much about Rio and the discussion about possible merger with Glencore. That caused Rio to fall. So that's probably why we had a bit of a pullback there. There's the materials index, just a bit of a different variation, but looking very much the same. So they're extremely positive. And if we look at the small caps on a weekly chart, that's also looking very positive. So we're seeing really good breadth in the Australian market as well. But let's look at the rest of the market, the Australian market. These are all weekly charts. So this is energy. 200-day moving average is flattened out and it's just starting to roll over. All the shorter-term moving averages have already well and truly rolled over. The price is well below the 200-day moving average. This is an index without any momentum at all. The banks, kind of in the middle, they're still uptrending, but they are looking more on the shaky side. And you can see that 3 of the last 6 or 7 weeks have been more significant downward pointing candles. There's healthcare, unquestionably in downtrend. There's information technology, unquestionably in downtrend, thanks to stocks like Xero, REA Group, Car Group, etc., and also WiseTech Global. So that's the way the Australian market is setting up at the moment. So just to summarise that, our dollar was at 66.25. What we've got is a mild short-term uptrend within what is an overall tight trading band that stretches back into early 2025. And it's showing strength while the US dollar is rising. And as I said, that's just a reflection of the fact that so many commodity prices are doing well. So it was all about resources in our market last week, and especially for the smaller emerging stocks. And when you maintain active watch lists that cover where the strong trends are, so I do that in America, I do that in Australia, and I also do it across different sectors, and this involves probably the best part of 400 or 500 stocks. You see trends, and I can't recall a period where the smaller emerging stocks part of the market was looking as bright and shiny as it is at the moment. So that divergence between those that are trending and those that aren't is about as stark as I've ever seen it. It really is quite something. And now we've also got, so we know that gold and silver have been running hard. Copper has started a few months ago to look much, much better. But we've now got other sectors joining in as well. Aluminium, rare earths, defence, just in the last little bit. And even uranium stocks are starting to look better. And of course, there's a reason for that. We'll get to that in a slide or two. So that's the Aussie market. Turning now to precious metals. Gold gained $177 for the week, so a big week. We breached through 4,500 and gold was up 4.1% for the week, so a terrific week. Translate that to Australian dollars. And I can remember it wasn't that long ago that I was talking about gold breaching $5,000 in Australian dollars. And now we're at 67.40. It's just extraordinary how much this has gone up. Silver was up 10% on the week and went over $80, closed just a touch under it. So for me, the precious metals market, while some stocks have got a bit overheated, some stocks that have doubled or tripled in a very short space of time, and they're just begging for profit takers to come back in. But as a general statement across the precious metals market, I think adding to your positions in total or individually on pullbacks is still a high probability thing to do. I don't see that gold producers or gold developers have really caught up yet to what's happened in the underlying metals. I still think that so many parts of the market are significantly undervalued. So this remains an add-on pullbacks kind of market for me. Now, silver has run harder than the others, and particularly in Australia, we've got almost nothing in terms of silver producers other than South 32, but then that's hardly a pure play silver stock. But with some of the silver stocks, they've run pretty hard, and so risk management has got to remain a probability, or a priority, I should say. So don't get all starry-eyed about how well the silver market is doing. Just keep calm and rational and focus on managing risk. We've seen massive inflows into ETFs, particularly in gold, in 2025, and we've still got central banks that are continuing with this de-dollarization trade. They're swapping their holdings of US treasuries to holdings of gold. And for the first time, we've now seen that flip over, and holdings in gold are now bigger than holdings in treasuries on average. Gold stocks, predictably, the money flows reward the producers first, and then it filters down the line to the more advanced developers, and then you get down to the more speculative explorers and early stage developers. So that process is playing out, but I suspect that it's nowhere near completed playing out. And if we look at GDX, the one that's listed on the ASX, it's up 148% in the last 12 months. So if you're wondering why gold stocks are doing well, then it's very broad-based. Turning now to some charts. So time to go look at some charts. We'll start with silver. This is silver on a weekly basis. So you can see we've had 1, 2, 3, 4, 5. One negative week, which was last week, and then again we're positive. So 6 of the last 7 weeks in silver have been positive. And it was only in April that we were trading in the low $30 area, and now we're trading at 80. So it's been one heck of a move. Now, there will be a correction to this. This trend is unsustainable. So this will correct. But let the market tell you when. Let the market take you out. Don't try and guess at this. It's the worst thing that you could do, because you can leave a great deal of money or potential profit on the table. There's gold in US dollars on a weekly chart. So we had a down week the prior week, and then we'll bounce back up again. So the last 3 weeks have really been up, down, up, but the momentum unquestionably remains to the upside. In Aussie dollars, also a finish, very strong, recovered from some early selling in the week and closed at the same all-time high as a couple of weeks ago. And if we look at the spread between gold and silver, you can see, because that line is plummeting very quickly, that means silver is going up faster than gold is. So that still remains very positive. And we're only now just getting back to the sort of long run levels, that ratio between silver and gold. The long run is somewhere between 40 and 65, depending on how you want to analyze it. So we're back into that range now. So there's been some catch up. But of course, there's no reason why silver cannot continue to outperform gold. No reason whatsoever. If we look at GDX, so this is GDX, the Aussie index. We took off on the 3rd of January, 2025. So this has been running for just a tickle over a year. This is a weekly chart. You can see we had one decent pullback. We had one sideways pause in the middle of the year. We had a 3-week pullback in October. But other than those couple of pullbacks, it's a very, very strong uptrend. And then if we look at GDXJ, which is, they're called the juniors, but there's so many very large cap stocks in here that it's not really a junior index in the normal sense. And that also looks very, very powerful indeed. All right, turning now to other commodities. Copper, $5.84, looking very, very strong. There's no question we've got a structural bull market here. It's going to last for decades. And not only that, we're now starting to see accelerating momentum. And I know that I was getting a little frustrated through 2023 and 2024 and the early part of 2025 because the copper price wasn't really doing what I thought the fundamentals dictated it should do. Copper stocks were not remotely doing anything like what I expected they should do given the outlook. And that gets back to what I talked about earlier, and that is if you overweight the logical conclusion, you can be completely on the wrong track. You can be into things way too early, get out of things way too late. So in my experience of nearly 4 decades, underweight the logical conclusion and overweight what the money flows are telling us. At the moment, the market is still favouring the low-cost producers, but that will modify in time as it has in the gold market. It starts with the larger stocks, the better fundamentals, and then it filters down the line. So I think as a general statement, buying the dips in the copper market has good probability around it. West Texas Intermediate crude is struggling. I'm surprised there hasn't been more volatility given what's happened with Venezuela. But I don't know, maybe the market's just so stunned by the audacity of that move. So for me, and I've been saying this now for probably most of the last decade, but particularly of late, avoid being long oil. And it's not because I'm absolutely convinced it's not going up. It's because there's just too many uncertainties. I mean, who would have thought America would waltz into Venezuela and kidnap the president? But when you see events like that happen, it just makes you realize the geopolitical world we're in at the moment, there's really nothing that's off the table. So how can you possibly invest in something in an environment that has that degree of uncertainty? There's the spot copper chart. So we're trending very, very strongly and have been since about August. Looking at other commodities, nickel really had a big surge, as you'll see on the chart, got up to about $19,000 per tonne. And the trigger there was Indonesia is planning to cut their 2026 production quotas. So the market, which has been looking at supply significantly exceeding demand for as far as the eye can see, is now starting to factor in something different. I'm sure there is a degree of short covering has caused the incredible spike that we've seen. That's normally what you see. So a lot of funds would have been positioned to the short side in nickel. So there's been some short covering, I'm sure. So what we've got is we've got a squeeze on supply by policy. And when you get that sort of situation, you get extreme volatility because the market, first of all, is not expecting it. And secondly, doesn't know what comes next. So you're going to get a lot of up, down in the nickel market. Is this sustainable? Or is it just a news-driven event? I have no idea. It's way too early to understand that. And it's a bit like lithium. If you think back 6 months, I was really skeptical about the bounce in lithium because I worried about all of the potential production that was on care and maintenance that could be quickly switched back on. So I thought the price of lithium will advance to a point, more supply will come onto the market, and that'll kill the advance. But in the end, I was proved to be wrong, and the lithium market has now demonstrated that it's a sustainable uptrend. So again, another lesson in underweight the logic. Uranium also had a good week. The spot is now at 82.75. So there's the nickel chart over the last 12 months. And you can see just in the last couple of weeks, we've spiked from around the low 14,000s to 18,500. And then we're starting to see this volatile chop. Extremely difficult to trade. And the other one too that is just starting to move, this is a 5-year chart of aluminium. This is starting to look really robust. So this is an exciting sector that I don't think too many people are talking about. So there's certainly some opportunities in that part of the market, and opportunities with both the world's biggest stocks, but also some suppliers to the industry. So you don't have to own the producers and take on board the commodity price risk, the mining risk. There are other ways to gain exposure to a more buoyant aluminium market or a more buoyant rare earths market, whatever it might be. So think more broadly than just the underlying metal. And there's spot uranium as well. So it's had a good couple of weeks. So you can see why I'm so bullish, because commodities are in strong uptrends just everywhere you look. So wrapping it up, the final message, and what is just so damn exciting for me for decades to come, and I do a lot of reading, and I do a lot of reading about trends and where they'll be in 2040 and 2050. Whichever time period I look at it, whichever 5 or 10 year slice of the future I look at, I see these sorts of things that we're really hurtling at a rapid rate towards incredible surges in advancement led by technology. And you've got to look at what will allow that to happen, because we do not have the resources now to meet the future that's hurtling at us very rapidly. We don't have the electricity, and there's going to be electricity bottlenecks, if not already, very, very soon. We don't have the advanced technology that is being rapidly developed. We certainly don't have the critical mineral supply that we need to build everything that needs to be built, all of the technical infrastructure. And of course, there's always a demand for bulk materials as well. And this is all feeding into, what does the future look like? It's quantum computing. It's robots on a scale that will absolutely boggle your mind. If you read some of the stuff that Elon Musk is putting out about what's happening in the robotics sector, it's absolutely mind-boggling. The growth of data centers, which I think everyone is now starting to accept, is a real and very sustainable megatrend. And of course, cybersecurity has been with us for several decades and is getting more and more difficult and challenging to overcome. So there are just so many exciting technologies for the future. I think we're all entitled to be very excited by it. And I liken it to a smorgasbord that gets changed every now and again. It never ends. The waiters and waitresses just bring in a few new dishes and take a few of the old dishes out. And we're seeing a bit of that happening at the moment. There's a bit of a periodical reset. We're seeing it in high PE stocks, particularly in technology. But the smorgasbord is still there. The table is still absolutely full with selections. We'll get new leaders emerging, and that's why I'm looking out to where are we going to be in 2040? What are the new trends that are starting to emerge? It's just so very exciting. Our task is to stay 2 steps ahead of everybody else, because everybody else who follows news headlines and tips and whatever, they get stuck in the crowded trades until it's too late and they get hit in the head. We want to stay 2 steps ahead of that. We want to be out front and picking out the new emerging trends. Because when these new emerging trends start, they don't run for a couple of months. They run for years, particularly if you're talking about sectors that have been in the doldrums, like uranium, like lithium, like rare earths, and there are others outside of the resources area as well. So my final message is really, really bullish, but it's important to stay with the money flows. Stay where the momentum is. So many opportunities. Why wouldn't you try to have almost all your money in things that are working now? Why would you want to have money tied up in things that just aren't moving? So there'll be beneficiaries of the rotation. We're certainly seeing that now. There's a very good case to be made that the end of 2025 saw the birth of a new mining boom that runs for a decade. I have no idea whether that's going to happen or not, but certainly the initial signs look good. Be very skeptical around the crowded trades, the one that everyone's talking about, the ones that are on social media. Be really skeptical about those, because eventually if you participate in those ones, you're going to get caught out unless you've got a very good exiting game plan. Buy the dips wherever you can. Sometimes you've got to buy into a very, very tiny dip, not much more than a pause, but try not to buy into a rapidly accelerating uptrend. Avoid chasing thin liquidity moves, and we've seen plenty of those in recent weeks just because of this seasonality. And a clear plan puts you on a good track, and you will get an avalanche of what a clear plan looks like and how you put it together in the Insiders Club for anyone who is interested in joining the group. Portfolio analyst last week, the first one for the new year, was taking stock of 2025. We looked at all the crucial elements around what happened in 2025 and what they told us about what are the crucial elements in a successful plan. What should always be in there? What are the things that never change? And we also covered my favourite copper stocks as well. So that was a very well-received addition. And anyone that wants to have a look at what we do, there is a 2-week trial for $1. So that's the easy way in to have a look at the philosophies and the practices behind what we do. But of course, if you really want the Rolls-Royce service, then it's the Insiders Club. So that's it for this week. There's more information on the website. There is my email address, and I'll be back with you next Sunday. Cheers.